Hi Jesse. Today is September 20th, 2011. I'm Joe Terril, President of Terril and Company, independent wealth managers with approximately $500 million under management. We'll be doing a new video update today to let our clients and other interested parties know our latest thoughts on the economy and the world of investments, particularly our updated thoughts on Europe and some of the problems the markets have been trying to deal with in the last 30 to 45 days. And we will resign ourselves, Jesse, to the conference room and get set and start talking about Europe and what's going on in current events around the world. Before we do so, let me remind people that Jesse Baker is doing our filming and our technology, and as always does a great job for us. We thank him for that. But I wanted to mention, Jesse, even though people cannot see you, you got a major haircut since our last video. Looks good on you.
I appreciate it, thank you. Now that I'm presentable, I might have to make my film debut in one of these.
Okay, if we get enough of a demand, you can come around to the other side of the camera and let people see what you look like.
All right, people, let them know.
Until then, let's resign to the conference room and start talking about what people really want to hear.
Sounds good.
So for the last 60 days at least, the world of investments is being dominated by the occurrences in Europe. What I want to point out for just a few moments is something that normal news media is not touching base on. Curing the problem in Europe is a very big positive. It is a very long-term good thing to have happen. What we're seeing is the European countries being forced to justify budgets, live within their means, figure out their economies, what they're going to do for a living in the world, and, if you will, what I would call they're being forced to de-socialize. The old socialism that ruled the politics in these European countries is being forced by the rest of the world to disappear. That is a major positive for the world. It's a major positive for growth. Any injection of forced capitalism upon these countries in order to make a living, if you will, is good for world growth, and it's going to be forced down their throat. So I just want to bring up the first part of this equation is I'm glad to see what's happening. Is the medicine to get there objectionable? Is the daily news headlines, the worries, the concerns, is the patient ever going to recover? Are these things difficult? Yes, they are. And it's not an easy problem to solve. I only want to point out that where these European countries are going to be forced to go is a very big positive, and it's a very big correct thing for future worldwide economic growth. I do believe that between the European Union and recently, as last week, as we've seen, central banks all over the world, Federal Reserve Bank of the United States, Bank of China, Bank of Japan, everyone is working on this problem, and they will figure out how these countries can renegotiate their debt, stop their socialism, stop their incredible spending, and actually move on to a more positive track. It may take time, but what we see that we disagree with most of the markets about is some type of major collapse that's going to bankrupt all the banks in Europe, or a major worldwide economic severe recession being caused by the fact that Europe is struggling with budget issues and struggling with this transformation into more of what I would say is quote-unquote a modern economy. We do not believe that is going to happen, and we are comfortable with the fact that the other world participants are doing everything they can to help these countries make the transition. Is debt going to have to be renegotiated? Yes. Is there going to be somewhat of a give up in control and a little bit of local politics? Yes. Are we going to see countries perhaps have to digest some issues that they really don't want to? Yes, we are. But it is very much a positive. So with that said, and just a little bit of a summation for Europe, I want to put it in proper perspective that where Europe is trying to go is the correct direction. It's the right highway that they're going down, and they will get there. And I do not see things that would create worldwide banking panics, worldwide economic collapses that would wreak havoc with investment markets. So we will go on now to maybe our third topic, which is a little bit of a projection by the markets as to where we're going with both the economy and investment markets. The worldwide investment markets have had a severe correction during most of August and a decent amount of September. Markets' knee-jerk reaction is to assume that the problems in Europe will create a worldwide liquidity crisis, will create banks that begin to go broke all over Europe, which would cause banks in New York to go broke, which might cause banks in Tokyo to go broke, and otherwise the entire world is going to slip into a severe catastrophic problem. No, that's not true. Most people that follow Terril and Company and have seen the things that we have either been on video about or we've written about, we've not been wildly bullish. We've been more concerned about the potential for inflation and how that may slow down the economy. We'll talk about that some other time. But right now, this severe market correction is wrong. The markets are, through their actions, anticipating that we're going to go into a worldwide recession, and it may be a severe worldwide recession. No, we do not think that's going to happen. We continue to look for worldwide growth. We see no indication right now of any type that we're going to have a severe worldwide recession. Are people slowing down a little bit while they assess the situation and try and evaluate it? Yes, they are. But overall, particularly in the United States, there is still reasonable economic growth, and considering our poor political climate we're involved in right now, there is still the expectation that we'll have 2 to 3% growth in the United States. Other countries in the South Pacific will obviously have higher growth than that, but maybe Europe may have somewhat of a recession, but we do not agree with the markets. This is not going to create a worldwide economic calamity. Therefore, some of the things in the investment world we believe are mispriced right now by people who are perhaps not really thinking this through and are overreacting. So let's talk a little bit about what we think is a good investment policy right now. We think a great investment policy right now, and we're not alone in this, but we believe that buying income is a great idea. We have transitioned, if you will, around the world to a situation where any type of reasonable interest rate, a dividend rate, income stream that is safe pays nothing. It pays 1/4%. In the United States, obviously, anyone that's priced CDs or 2-year government bonds or AAA corporate bonds understand the bonds have no value. Good quality short-term tax-free bonds have no yield. Therefore, a person needs to look at alternatives, because it's this investment climate that is mispricing investments, in our opinion. And with the recent pullback in prices, we think it's a great time to buy some income. Let's discuss just real quick, for example, AT&T with an approximate stock price of $28 and an approximate dividend yield of 6.25%. We believe that a 6.25% rate of return on AT&T is very acceptable to us, particularly because the company will continue to raise the dividend yearly. We do not see anything that scares us off to think they'd have to cut the dividend or there's any major problems. We think companies like this have the ability to become, if you will, income alternatives. Why would someone be interested in going and buying a CD that pays 0.5% if you can effectively invest in AT&T and make 6.25%? We think as time goes by and the market reassesses risk, investments like this, AT&T common stock, are going to become more valuable as people perhaps reassess it and think, you know, maybe a 5% rate of return is more logical on AT&T, and they bid the price up. We also believe that yes, financial banks' preferred stocks, which is a variation of loaning money to a bank, yielding close to 7.5%, 8%, and in some cases 8.5%, are excellent investment right now. If I go in the front door of a bank to the teller and ask them, I want to give you the money and I want you to guarantee this by the federal government, what do I earn? They tell me nothing. If I walk over to the investment part of the bank and say, I'm willing to loan it to you, bank, for you to use in your banking operations, and I'm going to trust that you're not going to go bankrupt, they'll pay me 8%. Why do I not want to make an 8% rate of return and do that if it's a bank that I believe is not going broke, that has excess capital? Those type of investments are available all day long. We, in general, believe the US dollar is going to continue to go down in value. We're still bullish on gold. We're still bullish on commodities. We think bonds are a horrible investment. We're somewhat now beginning to shape up and be a little bit positive on technology stocks. There has been this knee-jerk reaction predicated upon Europe and fears of a worldwide economic meltdown. Really excellent technology stocks are selling at literally 10 times earnings. That's incredibly mispriced. These are companies that should sell for 15 to 17 to 20 times earnings, because these are companies that are going to grow even in a slowdown in the economic world growth. So we really are buying a lot of income type vehicles. We think it's a great time to buy these things, yield 6, 7, 8%. Put as many of those type of investments as we can into a portfolio, supplement it with some technology stocks. We think that sometime in the next 6 months the market will begin to realize they have overreacted, that we're not having a major worldwide economic depression or severe recession. When they do, they'll reevaluate risk, and they'll begin to reevaluate some of these things as a much better investment than what they believed. In particular, back to our theme on buy income, the Federal Reserve Bank has already announced to the world they're going to keep interest rates at 0 for the next 2 years. That's a pretty good free hand to go and buy income without the worry that the Fed will cut your legs out from underneath you by increasing interest rates. They can always change their mind. I don't trust the Fed, but it's a pretty good indication that if we can buy things that yield 5, 6, 7, 8, and even over 8% rates of return, that's a good thing to do. We think that will help carry investment performance even with an economic slowdown that we're going to have. Not an economic recession, not an economic depression, not calamity, but a slowdown where maybe worldwide growth slows from 4.5–5% down to 3.5 to 4%, where growth in the United States slows from 3 to 4% to 1 to 2%. So we like these ideas, we're implementing them in our portfolios, and we think that as day by day goes by, more and more people are beginning to pick up on this and realize this. We want to buy before other people begin to enter the market after they discover this is the direction they should be going.
Close.
This has been Joe Terril, president of Terril & Company, Private Wealth Managers. And today is September 20th, 2011. We will be back in approximately 30 days or as events warrant with continuing updates. And Jesse, I want to thank you as always for your help.
Always a good time. I appreciate it.
And if there are any questions, our contacts are posted all over our website, internet, etc. We thank you for tuning in, and we'll see you in approximately 30 days. Good night.